What's up, everybody? So today I'm going to be talking about why my financial advisor is wrong. And it doesn't matter if you're a financial advisor, a boglehead, or a robo advisor, why you are investing wrong. Let's go ahead and roll the intro and we'll get started. All right, so before I get started, I just want to make this disclaimer. So this isn't financial advice. I'm not a financial advisor. I'm not licensed. This is just how I run my portfolio and how I view it and my reasoning behind it. With that understood, let's go ahead and get started. The reason I think most financial advisors, boglehead, and robo advisors are wrong is because they all follow roughly the same investing principle, which is the modern portfolio theory, which came up with by a guy back in the 70s. Basically what it said is that you can be well diversified by holding a really broad range of companies, which is fine. Through whatever iteration over time, it came.
Modern portfolio theory, it involves a type of dementia I just can't even classify.
To be that you should hold a large U.S. market fund, an international fund, and a bond fund. And because this was come up with in the 70s, this was before modern portfolios, indexes, globalization. And in my opinion, it just doesn't work. And financial advisors and these companies continue to recommend it for one reason: legal reasons. They don't want to get sued. Everybody recommends the same thing and it doesn't work. Well, then that's just prevailing knowledge. It didn't work. It's just like your doctor when you go to the doctor and they recommend that you send it off for lab. It could have had this issue going on, your entire life. You know what the issue is, but they still want to send it off to the lab, because if they don't send it off and it's wrong, even if it's a tiny percentage, they could get sued, and it doesn't cost them anything. Even if it costs you $100, it doesn't actually cost them. So it's free for them to tell you to send it to the lab. It's free for your financial advisor to recommend these portfolios to you guys, or free for target date funds, because sue them down the road because it was a bad build. They can just say, well, how it is. And like most professions, there's a certain range that you're allowed to be in. If you step out of the range, then the company says, hey, listen, our insurance won't cover you, or we won't cover you if you get sued. So there's a lot of incentive for people to just keep recommending portfolios, even if we have decades of data showing that they're not that great. So let's go ahead and get into it. My investing philosophy is pretty simple. I believe that a growth fund, a well-diversified growth fund, up until the age of 45. At the age of 45, you can evaluate where you are financially. Maybe grandma died and you have a bunch of money in a trust fund or inheritance. Maybe it's your only money and you really need to protect it. Maybe you own a bunch of rentals or a business that you really don't need this retirement money. But it's not just, at the age of 45, you kind of have a good idea of where your life is, where you're at financially, where you're looking like you're going to be, and you still have 20 years to make any adjustments on it. So that's kind of my very simple investing strategy. I want to take a look at looking back in history. If we look here, we're going to look at a couple different portfolio builds. So this first one is the Russell Growth 1000. I really like it. I got most of my portfolios in this. And then you have this Vanguard 2040. This would assume if, like today, you had about 20 years left to work, so you're about 45. So we're going to go ahead and say 100% in here and 100% in here. We're not going to do any contributions, and you're going to see why here in a second. Using this, looking at about a $40,000 difference on it. This fund only goes back to 2004, so assuming you're 24 when you got out of school and started working, $40,000 difference. And there's certain things that are dragging down your portfolio that they put in these target date funds. But now let's do it like how you would actually invest. So you have your $10,000 and you're going to contribute a fixed amount. Let's say you contribute $6,000, because that's roughly been what you would do on your IRA, and you contribute it annually. We don't need to rebalance it because they're both these portfolios. So now we take a look at it. Now you see a big difference though. 857 to 360 in your target date fund. And there's certain things that are dragging this fund down. If we go ahead and we take a look at the Vanguard target date funds, the allocation on them. If we took a look at, here's the 40 to 45. You got 55% in your equity, you got 29 international, and then you got about, 8% in bonds and cash. So right now, in my opinion, at this juncture in your life, you don't need bonds. When the modern portfolio theory came out, we can switch back over here. The modern portfolio theory came out in the 70s. Bond rates were 8%, went as high as 14%. Well, ever since the 2000s, they've been, next to nothing on it. So because somebody back when rates were close to double digits said that you needed it in them, they've just been putting them in, even though they've been at rock bottom prices year after year. They just continue to put them in.
Much of what is taught in modern corporate finance courses is twaddle.
No reason to. It doesn't make any sense. And then the other part of this is going to be your international. Now, some people want it. Some people really like it. I don't include any international in my investing portfolio for the most part because of the way globalization has worked. The S&P, if we go and take a look, this is the impact of the global economy on the S&P 500. Approximately 62% of the revenue came from foreign countries. So the revenue is being generated on the outside. Even here, of the domestic revenue, 38 came from overseas. So that means if you're having both an international and a domestic, where the domestic is already pulling in a lot of foreign funds, then you're just going to be overweight in it. And here's the other thing on the international side of it. When you buy an international fund, you're buying it in US dollars. They take that money, convert it to a local currency, and buy those foreign shares. When they pay out a dividend or they cash out, they take those companies that paid out a dividend in foreign currency, they convert it back to US dollars and put it into your account. In my opinion, companies are much more efficient at playing forex markets, currency markets. So if you're invested in international, in my opinion, you have to be right on both the direction of the stock market and you have to be right in the direction of the currency. And here's an example. Japan, this last year or so, has done very well. Their market's up like 20% or a really high number. If you look at this, what is this? This is the EWJ, which is the iShares Japan ETF. Over the 1 year, it's 13%. Year to date, you're at 9.75%. If you switch over to the DXJ, which is a currency hedged ETF, the 1 year is at 41%. The year to date is at 30%. That arbitrage is the difference of the yen to the dollar conversion. So even though the Japanese economy is going up, they've been devaluing their currency. So in order for you to capture that, you would have had to been in a hedged fund, which you could do. But in my opinion, companies, because they can hold the currency overseas and they hedge their own currencies, are much more efficient at converting currency over than just an ETF that's just when they get it, they convert it. And so you have two drags on your portfolio when you're looking at these. You have your drag of your bonds, and then you have your drag of your foreign currency or your international investments. And that's why when you get down to here, you get these huge swings in it. And this is my theory behind my investing. Better to be much more aggressive early on. When I first started investing, my dad had put $1,000 into the Russell 1000 ETF for me. And this was back in the mid 2000s. Within like a year, that portfolio had went down 40 to 50%. I think it went from 1,000 to like $600 during the recession. And that sucked. But now, if you are having a very aggressive growth strategy, you still have 20 years left. You've got almost $1 million, you've got 850,000 in it compared to 360. You can afford to be much more conservative, because if you're going to lose 50% of your portfolio, wouldn't you rather lose 50% when you had $1,000 in it? Even though you lose 50% of your portfolio, you lost $500. Here, if you're at 360, and let's say you're undersaved at this point, or your returns have been subpar because you have all these drags in your portfolio, you're going to have to be in equities longer, or you're not going to have saved enough. You look at Americans' 401k savings and retirement savings, the median is well under $100,000 at this point. And so you're looking at it, you're like, well, I'm going to have to be more aggressive. Maybe you get a few years down the road and your portfolio drops because portfolio number one at 20 years, he's like, well, I've saved enough. I can take a lot of risk off at this point. I can be much more conservative than the average. And here, we got to be much more aggressive. So if something were to happen towards the end, say the market corrects 20%, you only lost, the market only corrected 20%, versus here it may have corrected 50 or 60 or 70%, but your 20% is going to represent 60 some thousand versus 500 or 600, a couple grand. Even if you were here and it corrected 20%, it's still not as bad if it's here, and your correction of 20% because you're having to be much more aggressive in the market. Maybe at this point, in portfolio number one, you've taken a lot of risk off. You may only correct 5%. So that's where I don't understand, where people just get into these. They make it tougher than it has to be. What's going to happen once you reach 45? Everybody's life is going to be different. You can't just cookie cutter it and say, oh, my retirement's going to be just like everybody else's. You got to look at your individual financial situation at that point and say, yeah, things have turned out great. I won the lottery, or got a great job and I'm saving all this money. I'm doing really good. Or you got to say, well, I need to make some catch-ups. You're going to need to make a lot less catch-ups if putting the same amount of money into your portfolio, you have $850,000 versus you having $360,000. Now, some people will say, well, that's past performance doesn't predict future returns, which is true, but you can look at the economy, you can look at the markets. If you look at the total fund market or total world stock fund, 9 of the top 10 are U.S. companies. It could happen that the U.S. just underperforms horribly and that the rest of the world just keeps going on amazingly. But I just don't see where engine of the world stops and the rest of the world just keeps on chugging along. And people even say back in the 2000s, it's the lost decade. So like, well, you don't want to have a lost decade. Why? It doesn't matter. Because we don't invest for a decade. If you were in the market the decade prior or the decade after, you would still have been much better off in portfolio one than trying to be in international. Because the international funds got gapped. Even with this lost decade, by like 2015, the US market had caught back up, and by like 2018, they had doubled the international market returns. Same thing, if you were in the 90s, you would have been blowing out the international. So you lost a decade here. You didn't, it's not like the U.S., it's not like everybody did great, or it's not like the U.S. did terrible and everybody else did great. It's a worldwide recession. Everyone did terrible and they just did slightly less terrible. And then when everybody went great, they did less great and we went parabolical. When you look at the world, you can look at the way the markets are set up. You can look at companies that are in the market and say, I think technology is going to outperform going forward. That's my opinion. And I think that's most people's opinion, because if you really thought that you couldn't predict a sector, or it was just a blind dart throw about which sector was going to outperform, you would take the equal weighted S&P 500. You would take an equal weight, right? Because you would say, well, I can't tell if technology is going to outperform or utilities or finance is going to outperform, so I just want to be equal weight of everything. Which doesn't make any sense, because the equal weight is performed horribly compared to the market cap weight. So here you're just saying, I want to be even heavier than what the S&P would be in the sectors that I see having the most growth going forward. It's not a blind test. You can look at the companies, you can look at the balance sheets of these companies and say, what's more likely to do better, the banks or the technology companies going forward? In my opinion, in my thought process, technology is going to do much better going forward with AI, the hype around AI, and then whatever comes after AI that we all get hyped up about from Silicon Valley. You've got these financial advisors and bogleheads and robo advisors that just keep recommending building portfolios like this, because that's the way the lawyers have decided that if you do this, you're not getting sued if it goes wrong. Just like when your financial advisor said your mortgage-backed securities can't fail, and then when they did fail, they're like, well, everyone thought that. Some people got sued in it, but it wasn't because they recommended mortgage-backed securities, because they're doing shady things on the side. So my theory, kind of recap, is that I'm going to be very aggressive in my investing philosophy, but it's going to be a calculated risk. Most of my portfolio is in the Russell 1000 growth. You could cut it up any way you wanted to, or I could cut it up any way I wanted to. I could put it the S&P or total market fund and then also put the Qs in there. You could do technology sector ETF. In my opinion, the Russell 1000 holds, I think it was 504 companies in it. That's pretty well diversified. If you can hold the S&P and consider yourself diversified, you can hold the Russell 1000 growth and can just consider yourself pretty well diversified, in my opinion. So you have Americans that are undersaving year after year. Financial advisors that know that these funds that they're recommending are more than likely going to underperform because they've been underperforming year after year, but they can't tell you otherwise. So and when I sat down with a financial advisor, there's no way they could even match the returns on this. They couldn't even get close because they got to, well, I need to put in, bonds and I need to put in international. Like, no, you don't. Why? I understand the risk. Bonds may go parabolical. International TSMC may just take over more of the world, and whatever other funds are in this international fund. What's on the next list here? I don't even know. Yeah, look at it. Outside of look, there you go. Norvodisk. I think that's a drug company. ASML. I think that's another foreign company. But yeah, you look at these top, what is this, 20? And there's 3 non-US companies that are in there. So I just don't see that. In my opinion, you're not going to get a point where all these American companies just fail and the rest of the world just says, okay, that's fine. We're just going to keep chugging along great. We're going to blow you guys out of the water. And I don't see a point where the US ever drastically, on purpose, devalues their currency. Because it's a world reserve currency, they have an incentive to keep it strong. When I look at it, I would rather be over here putting the same amount of money in every month. I would rather be here at this 857. The second half of my investing career, take my foot off the gas, take less risks, and in the long run, you're going to be less volatility because you don't have to be as risky to make the same amount of money. How many people do you know that have undersaved and now they're reaching their 50s and they're like, well, I got to be all in equity because I got to take these bigger risks because I didn't save enough or my returns weren't as good as the financial advisors promised. And so now, instead of being more conservative, they're being less conservative, and they're being less conservative at the wrong time, the back end, when they should have been less conservative at the front end. If their $10,000 portfolio gets cut in half, they lost $5,000. Here, if their 360 loses 20%, they lost whatever that is. 60 grand. I don't know where I came up with the other number previously. You can tell math is not my strong suit. That's why you shouldn't listen to my investing advice. But anyway, that is my thought process behind my investing philosophy and why I don't listen to the bogleheads. I don't listen to financial advisors. I could be an idiot. I don't know. Tell me what you think in the comments. What is your investing philosophy? Are you all in on bonds and international? You think that Chinese are coming for us? You think that the Japanese were there in the 70s and Koreans were there whenever they were there? Whatever it is. But yeah, let me know in the comments below what you think, what your investing strategy is. If you like this video, if you thought it was amusing, or if you thought it was useful in any way, like, subscribe, share it with all your friends, tell them it's not investing advice, but have a great rest of your day.